India has been in the slow lane since October 2024. Can you tell us how this earnings season has been panning out?
Yeah, so a lot has been happening in 2026. I mean, especially when you look at India. Earnings season is now, almost progressed quite a lot. 497 out of 500 companies have already reported their earnings. But we had a budget season. We also had a European Union FTA free trade agreement deal being done. We also had a US trade deal getting announced. So a lot has happened. And in between this earnings season event, we have been closely following it. And one of the important headline numbers has been a great story from a revenue growth perspective. So the BSE 500 companies are reporting a revenue growth of close to 11.9%, which is much higher than the 8% growth rate that we have been used to over the last few quarters. So that has been a very, very good revenue growth rate. The earnings growth rate is a bit lower than our expectation. The earnings growth rate of all the companies which have reported their earnings, the median growth rate is about 10.8%. However, we are expecting about 13% kind of earnings growth. So that has fallen short of expectation.
A lot was expected from this earnings season, given the fact that GST rate cuts happened in September 2025. What caused the earnings season to fall short of the 13% expected mark?
Yeah, no, so we had a lot of positive policy moves. GST got rationalized last year, and we had one full quarter, of those GST cuts enabling multiple sectors like automobile. But I think we need to look at earnings growth in the context of two factors. I mean, one clearly is the nominal GDP growth rate. So if we all know, the nominal GDP growth rate has been much lower than what we are used to. We have been used to about 14 to 15% nominal GDP growth rate. The current nominal GDP growth rate numbers, because of low inflation, is in the range of 9 to 10%. So that, of course, has been one factor. But one big factor which has been a one-time activity which has happened is the new labor code implementation, which government notified last year. So as per the new labor code which got implemented, employers are now expected to have 50% of the total CTC for their employees being earmarked towards basic salary, which means that provisions which has to be done towards leave encashment or provisions that the companies have to do towards gratuity or the PF contributions would go up. So a lot of companies which have large pools of employees like Infosys, TCS, etc. had a one-time provision of 2,200 crores for TCS, more than 1,200 crores for Infosys, and larger the employee base, the larger the one-time provisioning which was done. So overall, there was a 2 to 3% impact just because of the new labor code which got implemented. But if you were to exclude that as a one-time factor, overall earnings growth has been fairly satisfactory, and it is higher than the range that we have seen over the last entire 2025. So the earnings growth rate has been continuously increasing, except for this one-time impact that we saw in the last quarter. So it has been a positive quarter from that standpoint.
Can you break this earnings season down into sectors? Which are the ones that are shining and which are languishing?
So clearly, because of GST rationalization, the two sectors which stood out, one was automobile and second one was FMCG. So automobile had a great 18% year-on-year growth. Two-wheeler sales, four-wheeler sales went through the roof. FMCG also, because of the price reduction, they again had about 13.5% year-on-year sales growth, which is very unlike the FMCG sector. But however, even outside, if you were to leave these two sectors out, even the other sectors did quite well. So capital goods, which was still under the tariff regime, they still grew their top line by 14-15%. Metals and mining had a 13% top line growth. Even technology sector had a 12% revenue growth. So I think pretty much all the sectors did quite well. If you were to look at, however, from an earnings standpoint, metals and mining stood out. Clearly, because of the commodity prices, they grew their earnings by 27%. Automobile had a 24% year-on-year earnings growth. So some of these sectors did quite well. I think that there are only two sectors which did not do as well on the earnings front. One was Telecom. So Telecom had a negative 14% earnings growth. We all know that the prices in the telco sector has not moved up as much, and so they suffered. And technology sector is also coming under impact of AI. So they are able to also grow their earnings by only 4%, and that too in INR terms. In dollar terms, it's actually negative. So these two sectors didn't do well, but outside of that, the core sectors, automobile, FMCG, capital goods, metals and mining, all of them had a brilliant quarter this year.
Switching gears, let's talk about the US. What is their earnings season looking like?
US had a fabulous quarter of quarter 4 2025, which ended in December. Their revenue growth has been 8.3%. The earnings growth came at 13.6%. So going into this earnings season, the expectation was that US will grow their earnings only by 9%, but they had a 13.6% amazing earnings growth. And especially the revenue growth is something which stood out because this time the inflation numbers have been low. So even with the low inflation, the US companies are able to grow their revenues 8.3% on a year-on-year basis. So beautiful quarter of 25.
Given the fact that the US performed 13.6 against the expectation of 9, what caused the sudden 50% upside of the performance?
The economic engine of US is chugging along quite well. We all know the GDP growth rate numbers which US reported, which was more than 4%. The capital expenditure in AI is still in a booming mode at this point in time. So the top 5 companies, when you talk about hyperscalers like Amazon, Google, Meta, they are going to spend $650 billion in capital expenditure on AI. So which is driving a massive amount of data center infrastructure boom, which is also leading into the boom for utilities, for construction, for semiconductors, for computing, and so on and so forth. So I think the AI is driving the economy a lot. But even outside the AI, the growth is also becoming more broad-based. It's good to see that companies which are in capital goods, companies which are in power equipment, all those companies are also showcasing a much higher growth. So yes, this has been a more broad-based growth, but AI has been a centerpiece of the growth story.
Could you expand a bit more about the sectors? Which of them are doing much better than the others?
Earnings expectation in 2026 are again higher. So analysts are expecting 11% earnings growth in quarter 1, but quarter 2, 3 and 4 they're expecting again 15% earnings growth. The expectation from technology sector is even higher. So analysts are expecting again 39% earnings growth from technology companies. From materials and financials, again they're expecting 22% and 17% respectively. Now, because the expectations are so high, even if there's a small miss in terms of the earnings, it could prove a little more of a setback for investors. So one has to be a little bit more cautious there. And AI is the center theme which is driving the whole earnings upgrade cycle. So the expectations are that there will be a massive amount of productivity boom because of artificial intelligence. And that's why everyone is so optimistic and hopeful in terms of the earnings coming out really well in 2026 again.
Drawing parallels to India, what is the outlook for India in 2026?
Yeah, India, as you rightly, when you started out, you mentioned that India has been a slow lane since October 2024. But right now, if you really were to look at all the clouds of uncertainty are already out of the way. So we look at the 2 trade deals, getting signed or at least progressing further. We look at good budget season. We look at government cutting on GST. They providing income tax relief again in the last budget, the one before this. Earnings season coming out well, and the last of all, FIIs have turned buyers in the month of February. So we are expecting Indian markets to do quite well over the next few quarters, at least in the entire 2026 calendar year. On the back of again relative valuations which have become a lot more reasonable right now, and with FII money coming in, there would be both an earnings expansion as well as there would be an expansion expected on the multiple sides. So we are very, very positive on Indian outlook from a market standpoint in 2026.
What are the risks that one should look out for as an investor?
Yeah, as I mentioned, the expectations for the US markets are quite high. So any small miss can result into corrections in the market. So one has to watch out for that. India, as I mentioned, we are in a much more solid wicket at this point in time. The only other thing which could impact the entire hypothesis for 2026 is geopolitical tensions, if any of them come out. But these are the 2 main risks that we see for the market. But overall, at least for the next couple of quarters, we are quite bullish on equity markets broadly in India and in some specific subsectors in the US market.
This was all for this quarter. Stay tuned for the next earnings season and more.